Big day for us today. CNBC unveiling the inaugural Financial Advisor 100 list. The firms on that list represent a combined $3.3 trillion in assets under management. They were ranked using a proprietary methodology developed by CNBC in partnership with data provider AccuPoint Solutions. And key criteria include total years in business, the average account size, and total accounts under management. Joining us now, the #1 firm on our list, Salem Investment Counselors, represented today by its president, David Rea. Welcome. Good to see you.
Thank you so much for having me.
First time on CNBC. It's great to welcome you here.
Thank you very much.
Tell us a little bit about your firm for those who don't know it.
So 40th year. This year is our 40th year anniversary. Mostly we manage money for high net worth individuals, some foundations. But just very long-term buy and hold folks. Lucky to have a great staff and to work for wonderful clients.
Man, you have, blue chip holdings, to say the least. Apple, Microsoft, Google, Amazon, Intel, Walmart, 3M, Disney, Pfizer. You love those big marquee names. How do you feel about the market?
I think it's fine. I think it's fine. I think I feel like I can make a guess if PEs are between 10 and 15 like they've been in my career, or if they're above 22, 23, I can say it's kind of expensive. In between 15 to 20 with interest rates where they are, I think it's fine.
You think some of the growth names that you hold are going to start to work again? You know, some of the FANG stocks, high growth tech?
Yeah, you know, the way we look at it, we're just really long term. You know, we've owned most of these. I think Pepsi we've owned for 30 years.
Oh, is that right?
Yeah. So, to me, they haven't stopped working. You know, I think like Apple, for example. I think they've got tons of cash, great creativity, trading reasonably well, and we just own them.
Yeah.
We don't pay taxes if we can help it, or transaction costs. We just own them.
Don't sell them, just hold them.
Yeah.
David, that feeds right to what I wanted to ask you about. What does the turnover look like in your portfolio? It sounds like very, very little, since you mentioned about taxes.
It's, I think through the year, so let's say we have a portfolio of 35 or so. You have to have more than 15 in order to avoid a big risk to one stock. Beyond 35 or 40 or 50, I don't know what the magic number is, you get the market in a way. So we own like 35. A couple times a year we've made a mistake and we sell something, or something trades up past where we want to keep it. So it's I don't know what that turnover is.
Very low turnover.
Yeah, I think very low turnover.
Is there a part of the market that you favor, and then the other part what you don't like at this point?
Yeah, right now we are heavy in technology, and that would be a big, I don't know, is Amazon technology? Is it so in my mind, technology. So we're heavy in technology, and we also own a fair amount of the financials.
David, I'm in the same business, and you must face a lot of the same questions that I get from clients.
Right.
Why active? You're obviously an active manager. Why active versus passive? Love to hear how you address that.
Well, being active, fortunately, as long as we've worked for most of these people, they feel like we've been able to beat the passive indices, and they don't have to pay taxes, and they can control turnover. And we talk to them about, gee, you might own a ton of Apple or something like that, and let's talk about, do we want to keep it? So it's just a lot of personalized service for a very reasonable price.
You have some financial stock exposure. And we talk about that group a lot, obviously.
Yeah.
You have higher hopes for that group over the next handful of months, if not longer than that?
Yeah, I have been wrong, or we've been wrong thinking interest rates were going to go up for probably the last 2 or 3 years.
You and most people, that's okay.
And
you have a lot of company.
And I kind of started my career in really, really small bank land, buying the tiny ones. But anyway, I think the big guys, J.P. Morgan, Bank of America. I think if we get a little break for them on interest rates, they're well capitalized, they've cut costs, and I think they work.
All right. We appreciate you being here.